Chapter 17, Investment Real Estate and Business Opportunity Brokerage. To begin with, let's talk about some ideas or terminologies relating to investment real estate. I think we already understand what potential gross income is and effective income and those kinds of things. Let's move on into some more important issues such as leverage. And I'm going to tell you this, leverage is the secret to investing. Other people's moolah, OPM. And the more that you can leverage, probably the better your return is going to be on that investment. Also, I want you to understand what a capital gain is. But before you can understand what a capital gain is, you need to understand what a capital asset is. A capital asset is anything you bought for income, business, or investment. And the gain comes in, it's the difference between what you bought it for and what you sold it for. And let me be more specific. It's your purchase price plus closing cost that you bought it for. Then when you sell it, it's the sales price minus your closing cost. In other words, closing costs are non-taxable. So capital gain is going to be very important. Now the basis in your property, again, the same thing. It's your purchase price plus all of your closing costs is going to give you the basis in the property. Also, if you do any kind of major improvements to the building, that'll add to your basis as well. Now, what is equity? Equity basically is your down payment or the difference between the value of the property and your mortgage balance. The word liquidity, I don't want you to confuse liquidity and marketability. Marketability means being able to sell something at its current market worth. Now, that may be more or less than what you actually bought it for. Liquidity means being able to sell something and make money or get your money back. The different types of investment properties, residential is probably going to be the #1 type of property that we deal with. We also have commercial properties, we have industrial properties, agricultural properties. As a real estate licensee, probably dealing with residential is going to be a more productive, although some people do enjoy office buildings and shopping centers and things of that nature. As far as advantages to real estate, there's going to be some advantages. One of them is going to be a good return on your investment. There are some tax advantages, but I got to tell you, it's not what you think. You probably need to see an accountant to be able to determine what those real advantages are. Again, leverage is going to be huge if you're going to get into the investment world. Paying cash does not make economic sense when you're dealing with investment real estate. What you're trying to do is build equity. And there's two ways or two prongs to building equity. The property has to appreciate, and secondly, you've got to pay that mortgage off. And that's why when I do an investment analysis for a client, I typically use a 15-year amortization rather than a 30-year amortization. The reason for that is the 15 years pays the debt down a lot faster. There are some disadvantages to real estate also. You don't like to talk about it, but one of them is illiquidity. And what that simply means is I paid $200,000 for it. 3 years later, I can't get but $175,000 for it. You paid too much is what basically happened. Also, let me say this, management fees can eat into your profit. So when you're buying an investment property, you have to make up your mind. Can I manage it myself? And if I have to turn it over to a management company, am I making enough money that it's going to cash flow? There are also risks involved, business risk, and let me tell you what that is. You bought a little investment property thinking that you're going to get so much rent. Well, the big boy in town shows up, a 300-unit apartment complex, and all of a sudden cuts your prices. Well, you may have to cut your rents, which means you may not earn as much as you thought you were going to. One of the ways that we analyze how well we've done is called the cost price versus profit. It's your made overpaid concept. And what we're doing in here is we're taking what we made, and let me tell you how you do that. You're going to take what you bought it for and compare it to what you sold it for. The difference between the two is your profit. Then you're going to compare that profit to what you actually paid for it. Made overpaid is going to give you your profit percent. Moving on into business brokerage, the question is, what is the difference between investment real estate and business brokerage? Business brokerage has to do with dealing with a going concern operation. And there are likenesses and there are parts of it that are not alike. The things that are similar in between investment properties and investment analysis and business brokerage is that typically real estate is involved. So the business broker has to know how to evaluate a building. The huge difference is, however, personal property or intangible assets. Real estate brokers don't have to worry about goodwill and franchises and things like that. Those intangible assets, business brokers do. So when you're dealing with business brokerage, you need to understand financial statements, profit and loss, balance sheets, things of that nature. When you're appraising real estate, you use a comparable sales approach, the cost approach, and the income approach. When you're appraising a business, you use the comparable sales approach, the cost approach, the income approach, and also the liquidated value approach. That one is one that is unique only to business brokerage. And that's all I have in the investment and business brokerage section. So what I'd like to do right now is I'd like to review this section with you. Chapter 17, Review, Investment and Business Opportunity. Advantages to real estate: good return, tax advantage, leverage, and equity buildup. Some of the disadvantages in buying real estate: illiquidity and management expenses. Leverage is borrowing money to increase return. There are some risks involved. Business risk simply means that your income is less than expenses. Financial risk means that there are no funds available to borrow. Business brokers must understand financial data. Liquidation value approach is unique only to business appraising. And that's all I have for the Chapter 17 review.